Hello, good day. I hope you are doing well. Today we are going to continue with the solving of questions under manufacturing concern or manufacturing organization. Definitely, I'm going to put the question on the screen right now for you to know what we are supposed to do. So that is it. Trial balance has been given, and we have the items like raw material purchase 62,000. We have sales 150,000, rent and rate 9,000. Inventories at 1st January 2021, 1st January 2000. Raw materials, work in progress, finished goods. We have furniture and fittings. The cost is 50,000, and the figure you see at the debit side is the book value or the net book value, meaning we acquire the asset. We acquire the asset at a cost of 50,000, and we also acquired plant and machinery 60,000, but its current value is 30,000. That means that the provision for depreciation for the two assets, furniture and fittings, is 30,000. You will deduct 20,000 from the 50,000, which will give you 30,000. Plant and machinery was 60,000, and the current value or the net book value is 30,000. So 30,000 from 60,000 will be 30,000. Then we move on to factory indirect wages, which is 3,800. This is factory overheads. We have royalties, that is direct expense, 8,300. We have direct wages, that is a return of a direct labor. We have receivables and payables. We have cash, loose tools, that is factory overheads item. Commission received, other income. Provision for unrealized profit at the beginning of the year, and provision for bad and doubtful debt. That one too will be at the beginning of the year. Then we have capital. So first of all, this is a question. The moment we have closing finished goods, it calls for provision for unrealized profit. Apparently, they've given us the initial figure for the provision for unrealized profit. To be in the question, it is 6,000. Please, have you seen the figure? It is 6,000. But to confirm that this 6,000 is correct, you kindly go and check the additional information. Okay, additional information B is saying that goods manufactured are transferred to the income statement at factory plus 20%. I've already given a clear lecture on how to compute for provision for unrealized profit in our previous videos. So you can go and check in the videos that I've already uploaded. The heading is provision for unrealized profit. I have detailed and in-depth lecture or teaching on that provision for unrealized profit. So what it means is that when you check the additional information A, we have inventory of raw material at the end of the year for raw material, work in progress, and finished goods, meaning that we couldn't sell all the goods we produced. And since we couldn't sell all the goods we produced, we can recognize the total profit on the goods we manufactured. Therefore, the profit on the goods that we couldn't sell must be derecognized. That is the reason why we compute for the unrealized profit. So, although it must be earned, but when you go to your statement of financial position, that profit element on the unsold finished goods must be computed and taken out from the closing finished goods. Okay, so if you look at this question, since there's a closing finished goods, we will have to compute for provision for unrealized profit. So what we have to do is that the initial one they gave was 6,000. The 6,000, since they are saying that goods manufactured are transferred to the income statement at factory plus 20%, it means that we have to change this 20%, which is a markup, to margin. So in every instance, in order to understand it, just convert this markup to margin, because the finished goods is priced as selling price, but the cost of manufacturing is always at the cost price. Okay, So 20 over 100 is the markup. Let's change to margin. It should be 20 over 120. So when you apply the 20 over 120, you could see that by applying to the opening finished goods, that is the 36,000 in the question. The opening finished goods is 36,000. You see, you will get the same 6,000. Have you confirmed? But if you do it 20 over 100 times 36,000, you won't get the 6,000. That means that always convert the markup. So if in the question they give you 15%, it will be 15 over 115. If they give you 30%, it will be 30 over 130 applied on the finished goods. The closing one we have to do it. The closing inventory was 30,000. Closing inventory of finished goods was 30,000. Then we apply the margin, which we've converted because this 30,000 is at selling price, or the value is at what? Sales. We wanted to sell and we couldn't sell. So 20 over 120 times 30,000 give us 5,000. Initially, the provision was 6,000. At the end of the year, it's 5,000. What has happened? The provision has decreased by how much? 1,000. And since provision is a liability and it has decreased, if a liability decrease becomes income. So when you go to our other income, you will see this as part of what our items there. When you are done, the closing provision that you made 5,000, this 5,000 has been loaded on the closing finished goods. So the closing finished goods value of 30,000 that we saw in the additional information, we have to deduct the closing or final provision for unrealized profit, PURP, 5,000 from the 30,000 to get the 25,000. So this will be the actual cost of the goods we couldn't sell. And this will be captured in our statement of financial position under the current asset. But mind you, when you are preparing your income statement, you can't use this 25,000 as a closing finished goods, because the income statement is prepared under the accrual concept, that we say that income or revenue must be earned not only when cash is being received, and expenses must be incurred not only when cash is being paid. So when you go to the income statement, whether it has been paid for or not, include all. So in the income statement, we are going to include the full 30,000 there. But when we go to the statement of financial position, that is where we are going to take out the profit from it and make it 25,000. Are we together? Thank you. The next thing that we are going to deal with, direct wages paid in advance, is 800 cedis, and rent and rate covers 15 months ending 31st March 2001. Please, it's supposed to be 2001, not 2000. In the question, the date was 2000. Okay. Every accounting period has 12 months. So if they are saying that it covers 15 months, it means that they've paid more than the months they were supposed to pay, which is the 12 months. So when you take direct wages, first of all, let's deal with the direct wages. What is the balance as per trial balance? According to the question, the direct wages they paid was 1,005. And the additional information is saying that they've paid some in advance, which is 800. If you've paid some in advance, it means that amount that you've paid doesn't relate to that particular year that we are accounting. And therefore, the 800 cedis must be deducted from the balance they gave us within the trial balance. Always, we deduct prepayment or advance payment and we add owings. So we take 800 from 1,005, you get 700. So when you get to your manufacturing accounts, under the direct cost, direct wages, instead of the 1,005 they gave us, it will be 700. Then the 800 will be what? Direct wages in advance means to be current asset. We paid. Therefore, this 800 will be under current asset. Direct wages in advance. That is expense prepaid. Expense prepaid becomes an asset and definitely current asset. Let's come to the CII, rent and rate. The total amount that we paid covers 15 months, as I have specified in my workings. So the first thing we have to do is that if the amount that we pay covers 15 months, we have to work for the rent per month. So total amount, it should be total amount paid divided by the 15 months. We paid 9,000 according to the trial balance, and it is for 15 months. So it will be 600 cedis per month. But how much are we going to charge rent and rate for the year? If you are paying every month 600, then every accounting year is made up of 12 months. So therefore, you multiply the 600 by 12 to get the rent and rate for the year, which will be 7,200. When we are done and we get to know that the rent and rate for the year is 7,200, then we can look out for the prepayment. Because they said it covers 15 months. That means 3 months is extra. or we've prepaid rent and rate for additional 3 months. So the rent prepayment will be the total rent we paid, 9,000, minus the actual rent and rate for the year. So we take 7,200 from 9,000 and we will get 1,800, if you can see the 1,800. Let's come back to bad debt. Additional information D. Bad debt amounted to 2,000. So when you hear something like this, you check your trial balance and see, do I have bad debt? Do I have bad debt in the trial balance? According to this question, there's no balance as per trial balance for the bad debt. So that's why I place dash there. So in a real exam, you can decide not to bring this. You can just write this. Then, since there's a further bad debt, I add further bad debt of 2,000 to it, which will give you total be 0 plus 2,000 will be 2,000. Then we come to the additional information that D, provision for bad debt is to be made 10% on outstanding good debtors. Good debtor is the same as what receivables. So first of all, you have to come to the receivables first. You have to come to the receivables what first. The receivables that we have per the question is 45,500. Since there's further bad debt, we must deduct the further bad debt to get the good or outstanding receivables or debtors. In case we are not having any further bad debt, then we would have applied the 10% straight on the 45,500. But this further bad debt means that the accountant couldn't take recognition of it and you have to do it. That's why we are deducting first. Because if you don't deduct, bad debt is a debt that you can't recover. So this 45,500 tells you that this amount of money people are owing you, they have to pay. At the end of the year, your management has gotten to a level that out of this 45,500, there's supposed to be additional bad debt of 2,000, or 2,000 out of the 45,500 cannot pay you. So if you want to know the actual people who can pay you, you have to deduct the 2,000 from 45,500 to get the actual receivables, which will be 43,500. It is on this actual receivable that you can make your provision. So when it comes to the provision for that, for the final or the closing one, the 1,008 is the initial one. This is the final one. It's just like the provision for unrealized profit we did. We always compare the provision. So 10% on the 43,500 will give us 4350. Initially, it was 1,800. At the end of the year, it has risen to 4350. So there's an increase of 2550, which will go to the operating expenses under the income statement. When you are done, you come and deduct the final provision so that the actual you've deducted your bad debt, you've deducted your provision that you have to. So this provision, it's just an estimation that aside the people that you think they can pay, 4350 cedis amount is also in doubt. So let me also make that 10. So the final or the net receivables will be 39,150. So if you go to your statement of financial position, receivables or debtors figure will be 39,150. Then E, they are saying that the proprietor withdrawn 5,000 cedis cash for his personal use. No recording has been made for this transaction. So this is a normal double entry, as you've seen. There were no drawings in the trial balance. That's why I placed dash. We add further drawings. So the further drawings was 5,000. 5,000 plus 0 will still give us 5,000. But the drawing was in the form of cash. Therefore, our cash balance will reduce. So after adjusting for the drawings, you could see that immediately I go to the cash accounts, brought the opening balance, and deducted the further drawings of 5,000 from it, and we got 8,000. F, depreciation has been maintained at 10% on cost for all fixed assets. And G, plant and machinery, which was bought 5 years ago for 5,000 cedis, was sold for cash 3,000 cedis on 1st January 2000, sorry. But no recording has been made for this transaction. Good. You see that in the cash accounts, I've brought sales proceeds. When we sold the plant and machinery, the amount that we received, the form of payment was silence. And in accounting, if a form of payment is silence, we use cash. So the 3,000 cedis cash we receive must be added to the cash balance to get our final cash balance to 11,000. Okay, that is it. The next thing that we are going to do is to actually pay attention to this furniture, the non-current asset schedule, because they are also depreciating assets with that. So the asset we have furniture and fittings, plant and machinery, if you've seen it. The cost is 50,000. But before we come to the interpretation of the non-current asset schedule, the moment you see that we've sold an asset, you have to compute the accumulated depreciation on the asset that you sold. And that's what I've done here. So the asset was being used for 5 years. According to the question, they said that plant and machinery, which was bought 5 years ago for 5,000. 5 years ago. That means that they've accumulated for 8 depreciation for 5 years. And they are saying that every year, depreciation is 10%. You can use this formula, the rate of depreciation multiplied by the cost multiplied by the number of years the asset has been in use, which will give us 2,500. Or if it is 5 years and every year is 10% on the cost, 10% times 5,000 will give you 500. It is on cost, straight line. So every year, 10 over 100 times 5,500. For 5 years, when you finish and you sum up all the depreciation for the 5 years, you get 2,500, which is the same as this 2,500 here. So it's either you use this or you use that. You still get the same answer. But if the rate of depreciation or the method of depreciation is reducing balance method, you can't use this one. You have to come and use this. So with the reducing balance method, what you do is that when you compute for this year's depreciation, you get 500. Next year, since it's reducing balance method, you must deduct the 500 from 5,000 to get 4,500 and apply the rate of 10%, which will give you 450. Unlike the straight line method that you have to every year, you have to do it straight on the cost. Reducing balance is different. When you are done with the computation of the accumulated depreciation, then we come to determination of profit or loss on the disposal. We want to know that the asset that we sold, are we getting profit or loss? So this is what we are going to do. We bought the asset for 5,000. This was the cost of the asset. And how much you've set aside as depreciation is 2,500. And we sold the asset for 3,000. If we add how much you bought the asset plus how much you've set aside together, we get 5,500, which is more than how much we acquired the asset for. When it happens like that, we say that, oh, we've gotten a profit because we've gotten the money to surpass, or like even it is more than the cost. So the difference becomes your profit. If the cost, at the end of the day, you add the accumulated depreciation and the sales proceeds together, and the cost is higher than the addition of the two, then we are saying that you've gotten a loss. You couldn't even get how much you acquired the asset for. So this profit on disposal will be added to your other income in the income statement. The reason why we compute the accumulated depreciation is that when you go to the non-current asset, that asset that we are selling, its portion is here. It's one out of the total we have here. So when you check the cost of furniture and fittings, 50,000, plant and machinery is 60,000. But since we are selling one of the plant and machinery, we have to quote disposal. And you could see that with the furniture and fittings is dash. But with the plant and machinery, you could see that it is what? 5,000. Please here, you don't bring 3,000. 3,000 is not how much you acquire the asset for. When you bring 3,000 here, you'll be understating the cost of the asset. So bring how much you acquire the asset for, 5,000. Because here we are dealing with cost, not selling prices, cost. So the cost of the asset that we sold was 5,000. When you finish, you get the total cost. So 50,000 plus 0 will be 50,000. 60,000 plus 5,000 will be 55,000. Then we come to the less depreciation. Please here, pay attention. We have accumulated depreciation. When it comes to the depreciation section, we have two: accumulated depreciation, and the other one is this year or the current depreciation. But when you take furniture and fittings, you can see that the accumulated depreciation is 30,000. Someone will be asking, how did you get it? Say, go back to the question. Plant and machinery, furniture and fittings, the cost was 50,000. It has been written in brackets, 50,000. And the debit side is 20,000. That means that the value of the furniture and fittings currently is 20,000, and we acquired for 50,000. So it has reduced in value by how much? 30,000. That is the accumulated depreciation that we have gathered so far. When it comes to plant and machinery, it will be the same thing. Plant and machinery was acquire 60,000. You could see 60,000. And at the end of the day, you check the debit side of the trial balance is 30,000. So the accumulated depreciation will be 30,000. This plant and machinery 30,000, you see, the asset that we are selling, the one that cost us 5,000, its accumulated depreciation is part. Since the asset is living, since this asset is living as part of our total cost, then it should go away with its total accumulated depreciation that we computed down here, 2005. Have you seen it? So we are going to deduct, that's why it is in bracket, 2,500 from 30,000, and it will give us what? 27,500. When you are done, you come to this year, so you can just do it once and add and deduct. Disposal for furniture and fittings is dashed because we don't have any disposal for them. So the this year will be based on the rate of depreciation, the method, and the cost. Here the method is straight line method or on cost. So 10% on 50,000 will give us what? 5,000. 5,000 plus 30,000 what? 35,000. Then you do the same thing here. 30,000 minus 2,500 plus 5,500, you get 33,000. When you are done, you take the total depreciation. You take the total depreciation, this and this, this and that. You take the total depreciation from. You take the total depreciation from the total cost here. So 35,000 minus 50,000 give you 15,000. 33,000 minus 55,000 give you 22,000. So if you go to the statement of financial position, furniture and fittings value now is 15,000. Plant and machinery is 22,000. But initially, furniture and fittings was 20,000 and plant and machinery was 30,000. So when you check the trial balance, that 20,000 you see there, if you take 5,000 from 20,000, what will you get? This year's only, you get 15,000, same thing. If you take 5,500 from, if you take 5,500 and the 2,000 because we've sold one. So first of all, 2,500 from plant and machine will give you 27,500. Okay, then you deduct, if you add all this and deduct this, you get 33,000. So 33,000 from 55,000 will be 22,000. That will be the current value. But initially it was what? It was plant and machinery was 30,000. So we charge this year 5,500. From 30,000, you will get 34,500. Yes, okay, let me take calculator and do this. The current value in the trial balance for plant and machinery was 30,000. So 30,000, then we deduct 5,500. You will get 24,500. Then the asset that we sold, its accumulated depreciation must be deducted. Minus 2,500. You see, you get the same 22,000. Have you seen it? So that's all. It's not difficult. This is additional information. Make sure that you are able to understand this additional information with the one that I just discussed with you. I will share the final solution on the page. So if you have any question, feel free. I'll put the solution there. And this is a detailed solution because in the book, we don't have this detailed solution. There is a solution for this question, but we don't have this detailed additional or workings for that question. Thank you very much and have a wonderful day. Bye.